Welcome back. Well, let's focus on the next management CAMS. For their Q4, their margins have improved. Strong equity inflows have aided the mutual fund business, while the cost-to-income ratio has also improved. We're now joined by Mr. Anuj Kumar, the MD of CAMS, who joins us to discuss the past quarter's numbers and the way ahead. Hi, Mr. Kumar. Good morning and congratulations on a good showing. Well, according to your earlier guidance, the non-mutual fund business, you expected it to grow by around 20%. But with these recent new developments, do you expect it to grow at a faster clip? And if you could tell us, what does it mean in terms of margins going ahead?
Hi, good morning. Thanks for having me on the show. Overall, if you see, we had sustained results in the fourth quarter. Non-mutual funds especially, revenue grew 52%. If I keep out the acquisition of Think360 on a constant base, they grew 38%. Look at it this way, that we've made major investments in building out the platforms for non-mutual fund businesses, especially for account aggregator, TSP, or utility, Bima Central, MF Central, etc. Now we are in the go-to-market stage where we are signing up new customers and we are scaling volumes and scaling revenue. So overall, this will be margin accretive as the build-out cost of platforms has kind of slowed down. That build-out has happened in FY22, 23, and 24. And now we will enjoy the benefits of scaling revenue in the same utilities.
Mr. Kumar, hi, good morning. Prashant here. So what will revenues in F25 grow by?
So if you see last year, we grew about 17%, a gross of about 165 crore of revenue addition. If there are no stressful phases in the market, which means markets hold out, I think a repeat of this should be entirely possible, which means expect us to deliver about high teens in revenue and maybe an identical profile in EBITDA growth. So about between 17-18% of revenue growth should be possible this year.
Got that. So high teens, so around what you did, 70% is possible in FY25 as well.
Yes, absolutely.
On the insurance side, where is that? So the IIDs mandate policies in electronic form. Has that started? Where is it at? And what do you make on dematerializing these policies?
So what's happening is that there is no explicit guidance for demat of insurance policies. There is explicit guidance on issuance of digital policies, which could also be placing them in the DigiLocker or just sending a PDF with an email. It is not a mandatory step towards demat. That's a different paradigm, which is not happening right now. What is definitely happening is that the new age consumer is beginning to realize the impact of the benefits of e-insurance accounts. Some of this has kind of kindled interest, the recent announcements, but there is no one-way street to demat in insurance yet. When that happens, I think the scale will be very large. Today, this will lead to just incremental volumes, but not a major transformation in the markets.
Okay, so I just want to get this correct. Between the MF and the non-MF business, what is the kind of growth that you see, not just in FY25, but over the next couple of years? Where will the larger chunk of growth come in from, and what could the numbers be?
We're expecting MF to continue growing about 15%, non-MF to grow in excess of 20%. Like you saw last year, non-MF grew 52%, but that was an exceptional year. When you blend this, you should see us at least in FY25 to grow about 17-18% revenue, maybe an identical profile in profits. That is something that I can see happening because the base effect is anyways playing out, which means the significant increase quarter on quarter in FY24 will continue playing out as a benefit to us. So that is something we definitely believe will happen in the coming year.
Okay, so high teens growth is what you're looking at. I want to also ask you about the investments that you plan to make in your non-MF business. How much will the quarterly run rate be? Because you do have cash on your books as well to the tune of around 620 crores. How do you plan to utilize that? Any kind of inorganic growth opportunities that you're looking at?
So in terms of inorganic growth, we had made two investments in the last 2 years. The first was a small outfit called Fentupal Technologies. Last year, April, we signed up with Think360 to buy majority and control in them. So we continue to look for opportunities. These will be in the B2B space. We are keenly watching both insurance and payments and anything that we can do in the alternative space. So we could make an announcement during the year. There's nothing definitive yet. But yes, from a cash position, we are in a strong place. We do dividend out about 65% of our profits. but we're carrying over 600 crores in the group, in the main company and across subsidiaries, which can be used to fund acquisitions as and when we are able to identify a target.
All right, Mr. Kumar, final question then before we let you go. The non-MF business is likely to grow at a faster clip. Could you tell us what does it mean on margins, point number one, and the cost to income ratio? What's the guidance?
So overall on margins, we have stated that we will be able to grow EBITDA margins by about 1% a year. I think the last quarter was an exceptional quarter where we grew EBITDA to about 46%. I think in the next ensuing 2 quarters, you should expect it to be between 45 to 46. And therefore, from a cost perspective, about 54-55% of revenue gets costed out. Expect that to happen over the next 2 quarters.
All right, Mr. Kumar, appreciate you joining in. Wishing you all the best out there. For the time being, the stock is holding in the green. As you said, high teens growth and margins at around 46% could be a one-off. Expected to trend a little bit lower in the time to come. Stock up 3%. Well, let's turn our attention